Okay, so in this video, we're moving into the income statement. The income statement, as mentioned prior videos at the beginning of this document, is the first one, the first financial statement we create. And remember, that's because the income statement solves for net income, which is necessary to update the statement of retained earnings, which is necessary along with some information about other equity accounts, stock balances, to get to the statement of stockholders' equity. So we're on the income statement now, and the income statement separates revenues, expenses, gains, and losses based on two really major groupings, what we call operating and non-operating items. So let's talk a little bit about what the income statement provides. It provides accrual net income. And so this is accrual rather than cash. So it's important that we remember the cash basis versus the accrual basis of accounting. And we understand that the income statement is delivering that accrual basis of accounting. And what does that mean? Well, that means that we're going to use the revenue recognition and expense recognition principles. So we're actually including with accrual both cash-based transactions, or I should say cash-based revenues and expenses, and our step four, adjusted revenues and expenses. So I'll talk about the difference between those two items in just a second after I finish writing this out. So we have both our cash-based and our step four adjusted revenues and expenses. Cash-based revenues and expenses occur when I perform the work for a revenue. I perform the work or deliver the goods and I receive cash at that moment. So the earning and the cash come at the same time. In those instances, I can record a revenue with the cash in hand. Cash-based expense transactions would be something along the lines of my employee started working on January 1st. They have no prior wages accrued. They work the entire month of January. And then on January 30th, I pay them a wage. I would match that payment as an expense for the month of January. And I gave them cash. So I would debit wage expense and credit cash. So those are the cash-based ones. Now, we also have expenses and revenues that arise from the application of the revenue and expense recognition principles without cash. So these are without cash. If you go back and look at our step four adjusting entries, you will realize that there was never a cash account adjusted. So accrual income gives us not only what happened with cash-based transactions, but also this extra important information of accruals. Operating and non-operating activities. So once we have all our revenues and expenses, which we do when we have the adjusted trial balance, we separate them into these two groups. Operating are expenses, revenues that are recurring and consistent. And the reason why they're recurring and consistent is because these revenues and expenses are essential. I have to start writing crookedly to get around this little annotation. They're essential in the company's business model. And the company's business model is just simply how they create profit. So maybe they're a freight logistics company. Maybe they're a software development company. Maybe they're a pharmaceutical company. Maybe they're just a retailer, right? So all of those different businesses have different models, how they enact their business, how they uh, what they provide their customers, the timetable on which they provide these things to their customers, etc. So all of those things that go into running the business model, those are normal operating expenses. This will be where most of our revenues and expenses are reported. Non-operating activities are infrequent and or, so it could be either, right? Sometimes they're just infrequent or sometimes they're infrequent, and they're related to investment and financing activities. I have to start writing crooked again. I'm sorry, it just bugs me. Financing activities. Hopefully, it doesn't bug you too much. So, what are investment and financing activities? Investment activities would be when we take the money we earn and we put it into stocks and bonds. We get interest revenue from those items. Maybe we bought them in a market to sell them when they appreciate. Companies do this just like everyday individual investors do. They can also invest in other companies, acquire other companies, they can acquire a majority, etc. Financing activities are when the company needs money and gets that money by either issuing stock or issuing bonds. Now, when we're talking about issuances, that means we sell them. So we either sell stock, we sell ownership in our company to people outside the company. That's one way we can make money through a financing activity. The other primary financing activity is borrowing, and that's where we create liabilities through loans or bonds. So investing in financing activities are enough in themselves to be non-operating. They don't have to be infrequent. So let's talk about some of these things that go in the various places. Sales revenue is always at top, right? The most, obviously, this is part of the business model. It results as a part of the business model. These can include product revenues. So when we're selling items and inventory, they can also be service revenues. Think about an accountant or a law firm or a doctor. Collectively, those are just our sales revenue. But companies, more and more companies I find are separating them on their accounts and income statements. And the practice set that you'll do for this class has both product revenues and service revenues. Now, linked to product revenues, of course, is cost of goods sold, but also linked to service revenues are cost of services. And when a company provides both goods and services and separates them out, delineates them on the income statement, those can be collectively referred to as cost of sales, right? Just generally, the sales we make have a cost. Some of them are goods when we sell inventory, some of them are the cost of providing services to our customers. That results in gross profit. Now, once we have gross profit, we have a subtotal. This total basically shows how the company is able to market its product or service, how much of a premium it can charge customers over the cost of the provision of those products and services. We then run into other operating expenses, and I use the term other because this cost of goods sold and cost of sales, these are operating as well. And these are operating revenues, right? Anything that comes from the day-to-day running of the business. And certainly if we provide goods and services, those costs will be operating. Within other operating expenses, just going on some of the expenses that we've seen so far, wages and salaries would be an operating expense. Rent, insurance, utilities, all these day-to-day expenses that the company runs into when enacting their business model. Ones that might be less familiar to you, research and development. Oops. And also one that you might not think is operating, but is depreciation expense. And will include both depreciation applied to fixed assets and amortization, which is applied to intangible assets. Now, most of these, I'm going to bring gross profit out here so I can kind of keep a running total. just a spacing thing, not something you would do or format on an income statement. I'm just running out of room on this handout. So if we have gross profit after taking our revenues and our cost of sales, then we're entering into this other operating expense category. Now, on most income statements, this is highly condensed. They will put most of these very common expenses into a single category called selling, general, and administrative expenses. So it's just a catch-all title to collect a lot of these operating expenses in one place. Now, the ones that are a little more specialized, they tend to separately delineate, like R&D expense and depreciation and amortization. Okay, when we really study the income statement in specifically as our focus, toward the end of the course, we'll talk why this happens. But for now, just understand tends to be that this is how companies report their information. This gives me operating income as a subtotal. And this is a very important subtotal for most companies because this is truly the profits we get from mobilizing our operating assets and conducting the work of the company before we include non-operating. And remember, non-operating items come from infrequent and or investment financing activities. So we don't have many that we know right now. I'll give you three very common ones. Interest revenue, if we have lent anyone money or have any interest-bearing accounts that we keep our money in, that would be a non-operating item. This is just our investments passively earning income, not necessarily part of our business model. Interest expense, which is accruing on any loans that we've taken out, any bonds that we have sold to finance our company. And finally, dividend revenue. And understand that this dividend revenue is our money received from owning other company stocks. So companies will often own other company stocks and trade them like any individual investor would, but also sometimes they'll hold just for the dividend revenue. So the non-operating revenues were that dividend revenue and the interest revenue, and the non-operating losses, expenses, that would be interest expense. Something else that might pop up here would be if we sold a long-term investment. No, I'm sorry, not just a long-term investment. If we sold an investment for a gain or a loss, that would show up here. And one other thing that might show up here, or one other item that I forgot to mention that would show up here in operating expenses would be if we sold PP&E or intangibles for a gain or loss. There is a distinction here because PP&E and intangibles are operating assets, whereas investments are not operating assets. So the gain or the loss from selling our operating assets is an operating expense or an operating revenue gain. Whereas if we invest in, if we have an investment, that's not an operating asset, that's a financing asset, an investment asset. So the gain or loss on that sale comes down here in non-operating revenues and losses. After we combine all of this with operating income, add these pieces, we get pre-tax income. And depending on whether that pre-tax income is positive or negative, if it's positive, then we're going to have tax expense. But remember, in the practice set that we're doing, or the practice problem we're doing with Richter, they had negative pre-tax income, so they actually got a tax rebate. If it's a tax rebate, you add that. because it reduces my pre-tax loss. You apply, subtract the tax expense or add the tax rebate, and that gives me net income, or if it's negatives, loss. So that's the income statement, the basics of what the accounts that we've looked at here so far in the problem, the accounts that you're more likely to be familiar with in your work with Alex and with Connect and with my problems. We'll expand it later, get into more detailed expenses and what really goes where and why we break it out the way we do. For now, know that what the income statement is, what it tells us, and how it distinguishes its formatting, how it separates revenues and expenses. Knowing the exact format would be a little bit beyond the first test, but knowing a little bit about it and using it as a map to figure out what goes where, that would be very useful. All right, so now we're going to turn our attention to the statement of stockholders' equity because we found our net income, for example, and now we want to insert it. Well, the statement of stockholders' equity, we're going to have a real simple view of it because we don't do a very large focus on it in intermediate one. Mostly we save that for intermediate two. It provides a breakdown of the changes in equity. So we're looking for the change over time of equity. Remember, again, how everything's related. It helps frame and remember the particulars about each. The balance sheet tells me where I started and where I finished. At shareholders' equity right here tells me how all of my equity accounts change from the first of the year to the end of the year. Now, this is important information for stockholders. They want to know, did the company issue more stock? What kind of profit did the company bring in through retained earnings? So it separates the equity accounts between contributed capital accounts and retained earnings accounts. Remember, the contributed capital is the capital provided by my outsiders. These are my contributed capital accounts. They could also include preferred stock and additional paid in capital for preferred. But for right now, we'll just concentrate on common stock and retained earnings. Again, not really pushing the equity section in great detail just yet. So let's actually use the starting values of Richter. We won't be able to do the entire statement of stockholders' equity until we do the income statement, but we can at least fill in the top, right? Where did we start? Well, looking at this, our common stock was 10,000. Our additional paid in capital was 250. And this is the unadjusted, this is the post-closing balance from the prior year, 12/31. So this is our starting point, 10,250. And the beginning point for my retained earnings was 312,650. So if I add that across, my total equity is 572,650. Now using the other numbers from our uh, our our problem here, what happened during the month, right? We had a stock issue. On 1/30, the company issued 1,000 shares of $1 par value stock, trading at 20 per share. How did we record that? Go to the journal entries. We debited cash by 20 and credited common stock by 1,000, additional paid in capital by 19,000. So the common stock account goes up 1,000, the additional paid in capital by 19, and the stock issue had no effect on retained earnings. So overall, we had a total equity effect of 20,000. And then we can go to the next row. Well, we need net income in order to fill this in. So we can't quite do that yet until we do an income statement. We'll visit that on Richter in the next video. Dividends were not paid by Richter during the month of January, so that is not going to affect any balances. When we recognize that net income, remember net income only affects retained earnings. It only goes into figuring out the ending balance retained earnings. So once we know our net income, we'll place it there, but it's not going to affect common stock and it's not going to affect additional paid in capital. So we can go ahead and write through the ending balances of these two accounts. Now all we need is this missing piece of net income. And then we'll be able to come up with the ending balance of retained earnings, which will give me the total equity balance for the end of the year. Okay. We'll do the income statement in the next video.